topic for discussion, as Karunya said, is maximizing alpha in the age of alternates and indexing. So on one side, there are the passive products, the index funds. On the other side, you have absolute return funds, which, where assets are absolutely fungible. You can do pretty much as you please to generate that alpha, and mutual funds are pretty much caught somewhere in between. But before moving on with that discussion, I want to make 3 points which will really set the context for this discussion very clearly. The first point is, over the last 10-15 years, the mutual fund industry has really grown tremendously in terms of size. So I was saying I was started off my career with mutual fund industry. Back in those days in the 1998, 99, pretty much barring that 2000 period when the dot-com crash happened, before that pretty much 90-95% of the funds would outperform the market. And I'm not talking about the assured return products of those days, the UTIs and the can bank funds and the BOIs and BOBs of the world. But the private sector mutual funds, pretty much 90-95%, there will be just 1 or 2 exceptions to that, but everybody pretty much outperformed because the size of the industry was really small. And of course, all of these smart people were managing money. They still do, but the marketplace has changed. The reality is that in a much bigger market like US, the last time I saw, 86% of the mutual funds, actively managed mutual funds, underperform the market. And this is, we've not gotten on to that stage. Mutual funds as a proportion of total equity is less than 10%, so probably we are not going to get there very soon. But that's one thing we cannot really take our eyes off. That's point number 1. Second point is the institutional framework within which the mutual fund the industry operates. And I want to quote Keynes out here, where he says, worldly wisdom teaches us that it is better for reputation to fail conventionally rather than succeed unconventionally. And Naren would relate to that very much, and I'm sure a lot of others will also relate to that very much. But they all know the constraints under which they operate. So this is the second thing which differentiates the mutual funds institutional setup versus what is emerging as a very competitive, where the competition is really coming to this industry from. The third point is the trade setup itself, which I think is a more short to medium term phenomena, where the markets themselves are highly overvalued. At least that's what I think. They may differ. And across the board, valuations seem slightly elevated. And the pockets of opportunity are, if stocks are cheap, they're probably cheap for a reason. Therefore, the overall macro trade setup also is not really conducive for very high level of alpha generation. This is my take. So these are 3 points that we need to take cognizance of, and this sets the backdrop for the conversation that will follow. So I'll start off with Naren. And today, in terms of size, and you also manage some of the largest funds in the industry, how big a problem is size in generating alpha?
Actually, one is you have to decide what kind of fund you want to run. And if you decide that you're going to become a closet indexer, and then it becomes a problem, because then you have to beat the benchmark and the kind of expense ratios that exist, it becomes a problem. So what we at ICICI Prudential decided is that we have to focus on hybrid, because in hybrid you are a provider of liquidity when the markets go down in a way. And that becomes very easy then. So in 2020 March, we could end up buying 10,000 crores of stock. So then, this whole concept of, are we large? Frankly, if instead of 10,000 crores, we had to buy 20,000 crores also in March 2020, it wouldn't have been a problem. So the size became not an issue at all, actually, because that's one of the reasons why we chose to focus on hybrid as a category, because size just did not become a factor at all. If you go back and think of March 2020, you would have realized that very, very clearly. The second is that finally at the end of the day, each fund manager has to choose what kind of style works. So if you look at our firm, like I enjoy being a contrarian, and when you're a contrarian in 2000 today, particularly today when as we speak, almost every PSU is going up at the rate of 10% a day. And go back 2 years back, the question that was asked of me was, do you think PSUs will ever go up any day? And that question, and you had to explain to people that we will cap PSU weightage in this fund. And there were so many people who used to come and ask, will you cap PSU weightage to this? You will not exceed this, no, at any cost. So, and today we have a opposite situation. So by being contrarian, it becomes easy in the long run. The problem is that people sometimes, if you look at people, they look at SPIVA and say, okay, in the last 1 year, have you outperformed benchmark? The more freedom that is given to people, that you will not have to look at benchmark on a 1 year basis, it becomes very easy to outperform benchmark on a longer term basis. But then that freedom may be more easily available to me because I have been there for long. But is that available to everyone? I do not know. So in between, what we did at ICICI Prudential along with hybrid and contrarian and special situation was we tried to launch closed-end funds. But then today we find that it's not easy to get approval for closed-end because what the regulator says is the fund has to be different. I don't think it's easy to find a different type of closed-end fund. But closed-end would have helped us a lot because in 2020, most of the closed-end funds that we were running were actually defensive prior to COVID, and we became aggressive post-COVID. So closed-end, one of the things we learned from the ultimate guru, Warren Buffett and Charlie Munger, was if you're closed-end, what happens is it enables you to be rational when the markets are irrational. But today in India, there are hardly any closed-end funds in the mutual fund space. You may have it in the AIF space, but you don't have it in the mutual fund space. So these are the ways in which we have navigated. But if you decide to be very conventional, then I think size will become a challenge. So how can we become unconventional? So what you do is you try to launch a business cycle kind of category, which is top-down, bottom-up. So you try different things actually so that scale doesn't become a challenge, because top-down becomes very easy to buy when again you'll have distress. Suddenly one day Fed will do something that gives you an opportunity. Then Fed will do something else that will become an opportunity. Something will go wrong in China that will give you an opportunity. So essentially scale is a benefit provided you're contrarian, and scale is a big problem if you're momentum. And that is what we realized, and that's why we are focused on hybrid, contrarian, and that kind of framework is what we decided as a house to focus on. And because finally at the end of the day, a mutual fund wants scale. We don't want to be a boutique, and that is the way we looked at it.
Srinivasan, you also manage some of the large funds. Do you think in today's environment you have to be a contrarian to be able to deliver alpha?
In the short term, probably yes, but I don't think so. If you're a long-term investor, so the contrarian philosophy, I think, is basically being cognizant of valuations. So are we cognizant of valuations? Yes, we are. But beyond that, I guess you don't need to be I don't think you need to be contrarian to generate long-term.
And at what size do you think size can become an impediment, if at all?
Well, I think size is always an impediment. The larger the size, the lower the investable universe in terms of the number of stocks. The larger the size, the higher the illiquidity. You need liquidity not only from being able to buy a certain position, but also being able to exit a position if you go wrong. So depending on what category you are, I guess if you're in the large cap category, size is less of a constraint because you're operating within a very liquid universe. But if you want to generate alpha, size, so we think we're constrained on size on a small cap category at almost $1 billion, probably less.
Sure. Neelesh, you probably don't worry about size as much, but one of the points that Naren pointed out was that his long experience with the company gives him that elbow room to be a contrarian when he wants to be. Now you have a fairly long track record of performance, but maybe not as long as Naren's time in the industry. Do you have that elbow room, and does an average fund manager really have that?
Old man, Naren.
Does the average fund manager really have that elbow room to be able to navigate the market the way he wants to deliver alpha, of course?
Yeah, I mean, if I look at the overall perspective, I mean, this debate of outperforming and the benchmark up to 2015 or so, 16 was not as much. If you look at, even today, when you look at large cap category on a 10-year basis, the median or 80% of the funds, they are outperforming. The problem is last 5-7 years. Until 2015, if you see the record of, let's say, median return or the category return, 10-year return, the alpha was 300-400 basis point in large cap. One is, if you look at what's happened at this point in time, I think the attribution analysis of why a median or an average fund in large cap, the alpha has come down, if purely on attribution analysis, is actually related to few stocks or groups. If you look at last 3 years, it is related to one particular group where the industry is under indexed, under owned. That explain about almost 1-2% sort of, and not difference is not much. So I think that doesn't mean the liquidity is an issue, but I would fully agree with Vasan that particularly that mid-cap, small cap cannot be a very large significant because markets are illiquid. I think the construct of Indian markets, see, alpha generation at the end of the day is a zero-sum game. If you look at mutual fund is about 8% of the industry, retail is about 8% of the industry. So what was the sense about 5 years back? Retail was 16%, mutual fund was 4%. All else being equal, while information, slight advantage is there, analysis, behavioral analysis is there with professionals. So if there is all else being equal, the institutional or the fund managers, they would probably have a better sense of identifying stocks and all compared with retail. Whereas as you touched upon US and all, literally entire market is institutional. Promoter holding is very less. So if you put it that zero-sum game, then 50% will outperform at the expense of remaining 50%. So I think there is still that construct, still remaining that active funds can sort of outperform vis-a-vis. The alpha probably could have diminished, but still 100-200 basis point is possible even for large cap, just like what we are seeing results on a 10-year basis. So long answer, but I think the attribution suggests that it's more to do with few factors, earlier a particular group, one particular company, couple of names in finance sort of thing, quality things. For last 3-4 years has been pretty erratic. But I would not blame it only on size, except for small cap or mid cap sort of category.
Sure. Anoop, what is your sense?
No, I think so. It's getting more and more tougher. There are more people doing this than what was the case 15 years back. So in terms, information gap which was there and which helped all institutions is now practically zero. In fact, we have got more problems to get information than the case of others who are not so much regulated. Second, I think so is that some of the conventional winners which have given us alpha over the last 10 years. So in 2008, if you were to remember, just the weight of HDFC Bank was actually less than 2%, and almost all funds had weight of 4-5% in their portfolio.
Right.
Pharma was a sector that most people didn't want to own, and you were slightly overweight on pharma between 2010 and 15, and you got all the alpha. So you had very distinct pockets from where you could get over, this as such. But over the last 5-7 years, the market has become very flat. And if you miss out 1 or 2 pockets which have done well, you can't generate alpha as such. So one is that competition in terms of small caps is very intense. Today, if you were to listen to a small cap company call, 80% of the questions are asked by people who are not from mutual funds. Which is something that I would have never imagined in my lifetime would happen, because we thought that we were the ones who were the chosen ones to get all the information from management and not somebody who works in a PMS or AIF. So there is a huge amount of competition, at least on the small cap fund. I don't think so it is size which is a factor, it is flows. If you have a fund which is very large in size and it suddenly starts bleeding, and it will bleed only when you have not done well, that it won't bleed when you're doing well, and when you're not doing well, you've made some errors, then it becomes difficult. So it is flows, I think, so you should focus more on rather than size. So today in small cap, one of the best performing fund is the largest size fund in small cap. So therefore size doesn't really matter, except and its size is 22 or 23,000 crores. Size gives you a lot of benefits. In the last 5 years, one of the largest source of alpha has been the case of IPOs. If you are a large fund, you get that alpha. If you are a small fund house, you are consigned to 2 crores, 5 crores, and in good issues, you're not even there. So some of the alpha which comes in small cap or mid cap has come from the case of IPOs, which are given to the top funds by their size, which they can't wish away from.
But there is the other side also, Anoop.
Yeah, of course.
There is the other side of the IPO game also, which some of them have.
Yeah, that I will whine for the things that really hurt me. I will not go and support the things that don't. But the thing is that you have the option to get the kind of allocation that you want. If you are a small fund house, the rule that we now have that given our size, that if we get a call second time from a merchant banker, then that IPO is not going through. So, then you just stay away from it. Because if it is good, then they won't call you. Because if you're a 15th ranked player, who's going to call you for that? So, that is one point which is there, in terms of size is very important. So I think, yeah.
Sure. So one of the points Anoop is making, obviously, is becoming very clear in the market that the information asymmetry is really gone down quite substantially, Naren. So does it then really become a behavioral play? Because the only way, there are only two things. Either you play on information asymmetry and mispricing therefore, or you play a contrarian, because behaviorally you feel that, okay, the market is not willing to look at this opportunity, but I have the gut to look at this opportunity.
It's nice as a country to see that if information asymmetry goes away, it's great. All annual reports are on the web, all transcripts are on the web. So it's great as a country to see that. That's what I mentioned, that it's a lot of it today is behavioral asymmetry. Behavioral asymmetry doesn't go away. Yeah, even in US.
So that is the real edge.
That's what gives you the edge. Even in a country like US, you look at the kind of extreme valuation you saw in 2021 in the form of SPAC and loss-making companies getting listed at ridiculous levels, etc. So I think it is only through behavioral asymmetry that we can actually manage, because information asymmetry is steadily going down. And that's a very good sign, because if we go back to our 80s and 90s, information asymmetry was the biggest source of alpha, and that has gone away. I think it's very healthy for the country in that sense, and we have to thank the internet and channels and money control and various other things for this.
Sure. So back to the same old question, that does the institutional setup in the mutual fund industry allow you the liberty to, have those behavioral traits, which is independence of thought, taking your call, being a contrarian? Does the setup even allow you to do that and leverage that as an edge?
Yeah, absolutely. No constraints at all.
Is that true, Neelesh? I'm hoping you'll say a no.
No, in the sense...
I run a fund which has 20 stocks, and I don't think we have any constraints per se. There are investors behave, so investors are worried about short-term underperformance and they withdraw money. That could be a problem, but that's an occupational hazard. But I haven't seen that actually being a meaningful problem so far, at least.
I'll ask you why I'm skeptical, but Neelesh first.
No, I don't think so. The industry has matured to, they look beyond 1 year number. They are looking at 3, 5. The entire ecosystem is giving that much rope. That is one. And second is, I mean, over time, some of the active distributors, they are actually looking at active share, etc. So that's an important matrix, whether how much you are deviating from benchmark.
Yeah.
And as long as, let's say, FT share is, if it is less than 40%, one can worry. But if it is 60, around 60, 65 or more, that means that fund manager is taking, then the better ratio is to look at information ratio and all.
She's asking, are you
So
constrained to manage money?
that's what I was about to come to that, because the active share, I just looked at the Morningstar data this morning. Active share for most funds, except Taurus has some bizarre 80% of something, but most other funds are like 50 to 60%.
Yeah, so that, see, we don't benchmark for the sake of benchmarking if you're seeing an absolute downside. So if some part is benchmarked and we are seeing conviction in that, there is no harm in that, number one. Number two, actually, you can fairly outperform with a 60%, underperform with a 70%, because active share increases the risk also. So if your question is, are we constrained? I don't think so constrained, but the fact of the matter is, our job is to beat the benchmark. That's first part, and then relative returns to peers, and then absolute return. Investors may look at, different set of investors will look at that. So how much active one should be active is also a function of the risk management of the fund management side. Anything less than whatever 50, 40 to our mind is not right, but anything more than 60, 70 is slightly taking higher risk, which means that if something were to go wrong, or something like events like COVID, or even longer term something were to go wrong, can pull down also, which we cannot sort of afford. But I mean, the answer I think is there is enough leeway given by the ecosystem where one can take reasonably risk-adjusted active share and to outperform. So there is no throttling by the system which is constrained. So I think still the underperformance which we are seeing, at least in our case or whatever the industry case, is more to do again with few stocks, few sectors, as Anoop also sort of which has happened. I mean, one group, people benefit for 5 years, then again, the entire industry was under index, something like that.
Sure. Naren, back to you. Do you think this is, especially Srinivasan and Neelesh are saying that the active share is 50% and that's good enough for you to create outperformance. Now, the competition to mutual fund industry, where it is coming from, whether it is PMF or AIF, those guys don't work with this kind of framework. Do you ever feel that is becoming a constraint across the board?
I think the fact that after 2000, for a long time, we have not seen a fall sustain. And the fact that you have not seen a fall sustain and you have had only positive markets all the time, that has created a certain sense of complacency among everybody in the system, whether it is investors, wealth managers, distributors, mutual fund salespeople, everyone in the system. And we will have to see one fall in the market, and if it sustains and the market stays down, how people behave. So I think the entire PMS-AIF industry has grown up only in bull markets. And we'll have to see whether it lasts one good correction and how it behaves at that point of time. And so I think it's too early for us to worry about everything, because I think, everywhere in the world, 2022 was a wake-up call, because the markets corrected. Even in US, most of the investors have been shaken up. Forget China or Taiwan or Korea or Japan or Europe. India is the only place where the investor believes that if you invest in equity, you'll never lose money. So I think that view exists. So we have competition from everybody today. But I think, once you have at some point of time, today if you have had 6-7 years of no negative return in Nifty, it's everyone believes that you will never have negative return. So that kind of behavior is a worry. And you have a lot of money not going into debt because people believe, why invest in debt? Anyway, you'll get positive return in equity. And that is a risk at this point of time. Let there be some negative return and it sustains. Today people believe even if March 2020 happens, April 2020 will immediately come and markets will recover. So that kind of thinking is settled very, very closely, and for people like me who have seen 90s, that is very worrying actually, and that's why right now I don't worry about PMSAF. If after a 10-15% correction which sustains, if that industry actually does well, I think they have arrived. Then we have huge competition actually.